Somewhere in Shanghai right now, a trader is writing a check not to buy silver, but to avoid handing it over. He sold a futures contract promising physical delivery of metal he doesn't have, and instead of sourcing that metal on the open market, he's paying the buyer a fee, a bribe, really, just to push the deadline back another month. He's not the only one. Across Chinese commodity exchanges, short sellers are bleeding cash for extra time because the silver they promised to deliver doesn't exist in the quantities they need. That's not a rumor. It's showing up in exchange data, in premium structures, and in vault inventory reports that have hit levels no one alive in this market has seen in over a decade. And yet, if you pull up a silver price chart right now, it looks quiet. After one of the most explosive rallies in recent memory, a surge past $120 an ounce followed by a gut-wrenching crash back towards $65, the metal is sitting around $79, consolidating, barely moving. Most traders have already moved on. The headlines have dried up. The volatility tourists have left. But here's the problem with trusting the surface. Paper markets reflect sentiment. Physical markets reflect reality. And right now, those two things are telling contradictory stories. The paper market says the party's over. The physical market says the pressure has actually intensified since the crash. One of them is wrong, and when that contradiction resolves, the move is going to be violent. This is the story of a gap between what the price of silver says and what the vaults in Shanghai actually contain. It's the story of a commodity that the modern world cannot function without, being consumed faster than it can be replaced. And it's the story of what happens when the market mechanisms designed to keep everything orderly start breaking down in plain sight. To understand how we got here, we need to look at a concept most traders hear but never truly internalize. And it starts with a word that sounds boring until you realize it's the loudest alarm bell a commodity market can ring. In any healthy commodity market, a futures contract expiring next month trades at a discount to one expiring 6 months from now. The logic is straightforward. Storing metal costs money, ensuring it costs money, and financing the purchase costs money. Those carrying costs get priced into longer dated contracts. This structure is called contango, and it's the default state of virtually every commodity market on the planet. When that structure inverts, when near-term contracts cost more than distant ones, it's called backwardation. And backwardation is the market's way of screaming that something has gone wrong with supply. Buyers are willing to pay a premium for metal now because they either need it urgently or they don't trust that it will be available later. Neither reason is comforting. The Shanghai Futures Exchange is currently showing one of the most severe backwardation episodes in its history for silver. Front-month contracts have pushed to record premiums over later-dated ones. This isn't a subtle signal buried in arcane data. It's the pricing mechanism itself declaring that physical silver in China is scarce, needed immediately, and not being replenished fast enough to meet demand. How did the vaults get this empty? Two forces converged at the worst possible time. Industrial consumption of silver, driven by solar panel manufacturing, electronics, and the broader electrification push, has been climbing steadily for years. China sits at the center of all three sectors. Then, the investment surge hit earlier this year, with buyers pouring into physical metal during the rally. Industrial demand doesn't pause because investors are also buying. The two streams stacked on top of each other, and domestic mining output simply couldn't keep pace. The result, warehouse inventories affiliated with both the Shanghai Futures Exchange and the Shanghai Gold Exchange have cratered to their lowest readings in more than 10 years, a decade of accumulated stockpiles drawn down in months. If this kind of structural breakdown resonates with you, if you can feel the gap between what mainstream coverage reports and what the data actually shows, hit subscribe and like. What comes next takes this analysis to a level that changes how you think about this entire market. Now, everything I've described so far is the foundation. The backwardation, the inventory drawdown, the dual demand squeeze. That's the setup. But there's a mechanism inside this market that reveals just how acute the shortage has become. And it involves the people who bet against silver being forced to pay for a problem they can't solve. When a trader holds a short position on a futures exchange and the contract approaches its delivery date, the math is simple. Either you deliver the physical metal you promised or you close out your position. In a normal market, this is routine. Warehouses are stocked, logistics chains are functional, and delivery is a paperwork exercise. But when the vaults are depleted, that routine process becomes a crisis. And the way that crisis manifests on the Shanghai Gold Exchange right now is through something called deferral fees. Short sellers, traders who bet silver would fall, are approaching their delivery dates and discovering they cannot source enough metal to fulfill their obligations. So instead of defaulting, they're negotiating with the long holders on the other side of the trade, paying them cash to extend the settlement window. Think about what that means in practical terms. These are market participants paying real money for the privilege of not delivering a commodity they contractually owe. It's the financial equivalent of a landlord paying a tenant to delay moving in because the building is not finished. Except in this case, the building materials don't exist in sufficient quantities, and nobody knows when they will. This isn't an isolated anomaly, it's systematic. The fees are being paid because the metal isn't there, and the metal is not there because a decade's worth of inventory cushion has been consumed by the collision of industrial necessity and investment appetite. And this is where the story stops being about China alone. Silver flows globally. When one of the world's largest consuming hubs can't source enough metal domestically, it reaches outward. Chinese buyers competing for international supply start pulling metal from London vaults, from COMEX warehouses, from every accessible stockpile on the planet. Arbitrage traders see the elevated Shanghai premiums and begin redirecting shipments eastward, chasing the price differential. Every ounce that flows to China is an ounce that isn't available in New York or London. The tightness doesn't stay contained, it radiates. What started as a regional inventory problem becomes a global supply chain recalibration, where every major silver hub begins to feel the gravitational pull of Chinese demand. The physical market is a connected system, and stress in one node propagates through every other. Meanwhile, the paper price of silver sits at $79, oscillating quietly between moving averages, showing a neutral RSI reading of 47, and giving every appearance that the excitement is over. The divergence between this calm surface and the stress fractures running through the physical delivery infrastructure is now wider than it was before the January rally even began. And if history has anything to teach us, divergences of this magnitude don't persist forever. They resolve, and never quietly. Here's what the full picture looks like when you assemble it. Chinese vault inventories at decade lows. Record backwardation on the Shanghai Futures Exchange. Short sellers hemorrhaging cash to delay deliveries they can't make. Global supply chains beginning to tighten as metal gets redirected eastward. And a paper price that has already corrected over 40% from its January peak, sitting in technical no man's land as if nothing unusual is happening. This is the anatomy of what veteran commodity traders call a reality check move. The pattern repeats across decades and across markets. Speculation drives prices to unsustainable highs. The inevitable crash purges the leveraged positions and resets sentiment. Everyone assumes the story is dead. But if the underlying physical deficit was real, not a narrative, not a meme, but a measurable structural shortage, it doesn't evaporate because the futures chart went red. The vaults don't refill themselves. The industrial demand doesn't switch off. The supply constraints don't resolve at the speed of a liquidation cascade. What happens next is that physical reality begins pulling paper prices back toward truth slowly, at first, then with increasing force, as the arbitrage between what metal costs in the real world and what a futures contract says becomes too wide to ignore. And there's a leading indicator already flashing. Mining equities. Pan American Silver up nearly 5% in pre-market, Hecla Mining gaining 2%, First Majestic rising over 1%, all showing strength while the metal itself sits flat. This is a pattern that has preceded major commodity turning points before. Institutional capital, the kind that moves early and moves quietly, often positions through equities before the underlying commodity confirms the direction. Mining stocks offer operational leverage. A moderate increase in silver prices can translate into outsized earnings growth. When smart money accumulates mining shares during a period of metal price consolidation, it's worth paying very close attention. Here's the question that sits at the center of all of this, and it was one that almost nobody in mainstream financial coverage is asking directly. If the physical silver market is more stressed now than it was before the rally, and the paper price is 40% lower, what exactly is the paper price reflecting? Is it reflecting reality, or is it reflecting the aftermath of a speculative washout that temporarily overwhelmed the supply-demand signal? Sit with that for a second. Then tell me in the comments where you come down, because the answer shapes everything about how you position for what's next. The technical structure adds another layer. Silver is compressed between its 50-day moving average near 79.26 and its 9-day average near 78.95. The first level to break will likely dictate the next sustained move. Above the 50-day, and momentum traders pile back in with a clear path toward the January highs above 120. Below the 9-day, and the market risks retesting the February low near 65, or even the descending wedge support around 59. The range is narrow, the coil is tight, and the fundamental backdrop is anything but neutral. Now, intellectual honesty demands something here. The bullish case built on Chinese vault depletion is compelling, but compelling doesn't mean inevitable. Backwardation can persist for months, even years, without triggering the explosive repricing that commodity bulls anticipate. Chinese demand could soften if economic growth decelerates or if investment appetite rotates elsewhere. Global mining output continues, and elevated prices incentivize producers to bring marginal supply online. And the macro environment, a strong dollar, a Federal Reserve in no hurry to cut rates, creates a headwind that can suppress precious metal prices regardless of what physical inventories are doing. These aren't minor caveats, they're structural counterweights. Anyone who ignores them is building a thesis on one leg And single-leg theses tend to collapse when they encounter a reality that doesn't match the narrative. But here's what the asymmetry looks like. The downside scenario from current levels, a retest of the February lows, possibly the wedge support, represents roughly 20 to 25% of risk. The upside scenario, physical reality reasserting itself, paper prices converging with the shortage signals, opens a path to 50% or more. That's not a prediction, it's a risk-reward observation, and risk-reward is the only honest framework for navigating a market sending contradictory signals. What matters now is specificity. Watch the Shanghai premiums. If backwardation deepens, the physical stress is intensifying. If it compresses, the situation is resolving. Watch vault inventory reports from both major Shanghai exchanges. Continued drawdowns strengthen the case. Any restocking changes the equation. Watch whether deferral fees persist. They're the purest signal of deliverable metal scarcity. Watch the technical levels. 50-day EMA above, 9-day EMA below. And watch the mining equities. Because if institutional capital keeps accumulating while the metal consolidates, the message is hard to misread. Remember where we started. A trader in Shanghai writing a check not to buy silver, but to avoid delivering it. That single act, multiplied across an exchange, reflected in decade-low inventories, amplified by record backwardation, tells you something that no price chart can capture. It tells you that the metal is needed, that it's scarce, and that the mechanisms designed to manage scarcity are under strain. The price will eventually have to reckon with that. Markets can ignore physical reality for weeks, sometimes months. They cannot ignore it permanently. The only variable is timing, and timing is the one thing no analysis can give you with certainty. So stay patient. Stay specific in what you monitor, and understand that the most important moves in commodity markets don't announce themselves with headlines. They build in vault inventories and delivery reports and premium structures, the places most people never look. You're looking now, that already puts you ahead of the curve. The question isn't whether the gap between paper and physical closes. It always does. The question is whether you'll be positioned when it happens, or whether you'll be watching from the sidelines wondering how you missed it.